Good morning. We are at the beginning of a brand new week. We had about 49 basis points of sell-off last week, which ended our 2-week run of recovery from the huge down day we had on July 5th when the benchmark bond went down 200 basis points. It is Monday morning, and welcome to the Mortgage Market Minute. I'm Jed Wonderly with Noble Home Loans. We are starting off the week on a bit of a roller coaster ride this week. We've got already the mortgage bond market has started off higher, then immediately dropped down about 20 basis points. We're up by about 10 basis points at the open, dropped down about 20, and now we're back above water by 3 basis points as I give this report. We're down, as I mentioned earlier, we were down 49 basis points last week. We probably could have been down a lot further considering the fact that there was a plethora of very strong economic news, such as existing home sales and new home sales both came in quite robust. Existing home sales, I believe, if I remember correctly, was a little above expectations. New home sales was a little bit below, but still had some very solid numbers. The other thing that we saw was Michigan's Consumer Sentiment Index was also quite a bit higher than what was expected, and a few other good pieces of economic news that happened last week. This week, the big thing that's gonna be the key is the employment report. Friday morning, we will see the employment report from the Bureau of Labor Statistics, and that is going to be a huge factor. It is currently at 7.6. The expectation is that the report's going to come in at 7.5% unemployment rate. I wouldn't even mess around with that. If I were you, I would lock ahead of that report. We're going to see, we have another FOMC meeting this week, and that's probably going to result in a little bit of a language change to try to ease the market. The problem is that the language is going to probably be something along the lines of, hey, we're going to keep the Fed funds rate low for quite some time. That's not a big deal because that's not what interest rates in the mortgage market are all about. The mortgage market interest rates are determined by buying and selling of the mortgage bonds, and right now the Fed over the last few years has been propping up that price with their quantitative easing program, and that's probably going to be tapering relatively soon, probably most certainly by the end of the year, and then probably ending that program by the mid part of next year. So that's the more important thing to keep your eye on. You might still see a little bit of help from that, from the comments from the Fed, but again, the key factor is the employment report on Friday. And the last time that happened was July 5th. We had better news than expected with higher jobs created, and as you recall, that was a 200 basis point down day in the mortgage bond market, which sent rates up about 0.5%. I would definitely lock before that report, and feel free to call me at 702-812-1214 if I can help in any way. Have a great week, and be safe. Take care.